following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to start out the show here with the German DAX like we always do. As you can see, it's been following this down channel for quite some time. We've just completed a small ABCD pattern yesterday. The market has held up, relatively well. We need a move, above those old highs, which is above 10,600 and change. That would probably signal some type of a breakout should we get that, but right now it's still in this trading range. The big news of the night, folks, was the pound versus the US dollar. We had a flash crash type scenario. They're not sure what actually did it. You should probably, if you have an interest in it, you should probably Google what happened, because from what I can understand from talking to some of my friends in the Forex business, that it was only the pound versus the dollar that was affected. The pound yen, of course, was a little bit, as was the pound euro, but nothing like the pound versus the US dollar. Let me try to show you what really was going on here over a period of time. This is not nearly as bad as what happened with the Swiss bank. If you remember, a couple of years ago, they dropped it $25,000 in a matter of a few minutes. And then the market, gradually worked its way back higher. But the key point to look at here, this is a 15-minute chart on the British pound. If you remember yesterday, we were looking, to buy this at the 126 level. But I really tried to emphasize, hopefully the right way, that anything below 126 was really, really negative. I didn't think it was going to be this negative, but you can see that it went from 126 to 119, 700 handles. That's 700 points. That's a huge amount. Not as bad as the Brexit one. If you remember the Brexit, we were down 14 points, so that was not nearly as bad as you could possibly see. But this is a very orderly market. As you can see, when we went down here, we rallied back right up to the 61% retracement of the highs of October the 5th. And since that time, we've just been, going back and forth between 124 and 122. So the market is actually holding up incredibly well, at least from the perspective of a technical perspective. Now, what we want to do is we want to see what happened, and you really need to do this because this is something very unusual, and you need to pay attention to what is happening. So if you'll take a look at this, the pound, you'll notice that once it broke the 126 level, it just was a straight down shot. Now, this is a 2-minute chart. Believe me, folks, I was not here at the time this was happening, but a couple of my friends were, and the spreads on the pound were 100 points between buys and sells or more. And then when we got down to that 119 level, you see it actually started trading a little bit, and it traded, relatively well for about 10 minutes between 119 and 123, and then went into this protracted trading range. So it's a legitimate thing, but I'm not sure, why it's going to happen. My good friend Byron Tucker called me this morning and talked about this, and he reminded me of the very first fat-fingered air we had, which was back in '95. He said this was at the Merck, and we were both long since no longer floor traders, but we still had a lot of contacts there. But there was a young lady in the bond pit. She was a clerk, a very attractive young girl, and a couple of the guys there, like young people do, they're kibitzing back and forth. And she was sitting on a chair, and she hopped up on the table, and she accidentally sat on the computer, and she sold 20,000 contracts of bonds, and cost Merrill Lynch $20 million bucks. Didn't even lose her job, believe it or not. And anyway, that was the first fat-fingered air that we heard of. But there's been some others, of course. But and they're not even sure if it was a fat-fingered air or not. That's just what the problem is, folks. This is why this is so unusual. The foreign exchange banks that when we trade forex are consisted of 13 of the major banks of the world. This is Citibank, Deutsche Bank, JP Morgan, Saxo Bank. All the major banks have their own foreign exchange departments, and they report their trades, their bid and offers on all of these things to the Forex clearing place that gives you the data, and then they give it to you free because they want you to trade, and it gives you the spreads that you're looking at. So this is what's actually happening, and then you'll be able to see how this stuff works. That's why it's so unusual for all 13 banks to be hit at the same time. That just doesn't happen in the foreign exchange markets. So it had to be at a time when it was very illiquid, it would be my guess. And also, I don't know what caused it, but remember the number of people that bought it down there, right near the bottom are very, very small, as you can see from the chart. So this is an outlier event. The good part is that if you had your stop in, no problem at all. And that's the main thing that we want to be, keeping in mind on when we watch, some of these things, because it's, it's pretty important to follow how the mechanics of some of these things go, because what you hear in the news is not always what it actually is, as we can see from watching the things that are going on with this circus we call the United States election. Anyway, keep in mind that this will rectify itself. Now, we need to look at the British pound here, because if we go back to where we were from 1985, let me just show you what happened here. If we go back to 1985, if you'll see on the left-hand side of that red arrow, that was when they were having the Plaza Accord in New York City at the Plaza Hotel. This was I think it was the G8 at the time, but these were the major countries. They got together to set policy and stuff like that, and this is what happened right after that. The market had a huge gap, and of course it continued to go higher and higher. Well, we have filled that gap. That's the main thing to look, to watch. The second thing to look at is to look at the time frame between 2000 and 2015, and you're going to see a very symmetrical three-drive to a bottom pattern. We also have the ABCD structure in here. So we need to be watching this British pound, because this might be at a really key level that could have some tremendous upside potential if, and the big question is if we get the right pattern, to enter the market, and that would be to have a really nice Gartley pattern over a half-hour hourly chart, so that our risk would be very, very small, in the neighborhood of about 60 pips, which is about $300. But as you can see, the swings on these things are thousands of dollars. So this is a really good risk-reward potential if you have to get in some of those things. I want to put my hats off to Mr. P in the room, because he was saying that we were heading down to the 122 level in the British pound when we were talking about this yesterday, and I had to agree that if we got below 126, that would easily be the case. And we got there in about 2 minutes. So we'll see. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed with TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, I've had two questions. First, if you want to trade Forex, there's some ETFs available. I frankly don't like ETFs, but if you're going to trade for a longer time frame, for anywhere from a few days to a few weeks or months or even longer, the ETFs should be okay, but I would really check them out a little bit better. The foreign exchange is just so easy to enter that the ETFs just don't follow into my wheelhouse. So that's one thing. The second thing that someone asked a question about, how the stops work in the foreign exchange. They work just like they do in our stock market here. If you put an order in, let's say the British pound is trading at 123.56, there's going to be a spread on that. In other words, people want to be selling it at 123.57, buying it at 123.52. Usually the spread is about 2 or 3 pips in the British pound, but when markets get really crazy, the spread widens up. If you have a stop at 123.50 and there's no person willing to take the other side of that trade, it'll go down until the next person is standing in line, to buy something. And so this is the thing that you have to be, prepared. Usually the slippage is minimal. I mean, really minimal, because you're talking markets that are, $1 trillion, maybe not $1 trillion on the pound dollar, but the euro versus the dollar is certainly, it does $1 trillion a day. And, but the pound is probably well into the billions easy, because it starts early in the morning and goes all day long, all through Asia. So those are, large amounts that are going. And a lot of it is speculative, but a lot of it is people that are actually, placing hedges against the pound versus the dollar because they want to be paid in their own currency. And that's how the whole thing works. What's so beautiful about it is that technically it works, extremely well. So, but the stops are the same thing. Sometimes, let me give you a little tiny bit of advice. The worst order that you can possibly put in is a stop limit. In other words, you want to be stopped out, but you're limiting it to that price. In other words, you don't want to get a really bad fill. So if the pound is trading at 123.50 and you have a stop in at 123.49 and the market goes through, in other words, there's nothing but offers, and it goes to 123.45, your stop has not been triggered because you weren't filled at your limit price. I can remember 35 years ago, I was doing a case for a law firm in Los Angeles, and one of their best customers was a bank, and they should have understood this order, but they called me in as an expert witness to try to explain what happened. And I looked at the order, and it was a new clerk. It was a trader. It wasn't a clerk, and he put an order in on a buy stop with a stop limit. In other words, it had to be filled at his limit. Well, it gapped 30 or 40 pips above his limit and then ran like crazy. I mean, they took a monster loss, I think well over $7 or $8 million, and it was because the order was placed wrong. Folks, a stop limit is the worst order. In fact, when I was, at the Merck, we used to talk about to the committee members to really disallow this. It was a terrible order, and but some people still use it, but I frankly don't. I don't recommend. Well, it's a suicide order, so don't do it. You want to be out of the order. You want to be out of the markets. Remember, it's much better to be out of a market wishing you were in than in a market wishing you were out. So you don't want to use a stop limit order. Just use a regular stop order. If you get a bad fill, it's a cost of doing business. It doesn't happen often, but it does happen sometimes. It's just like breathing. You got to accept it and move on. But don't use a stop limit order. Not a good order. It's just something that is not doing too well as far as being the way to run. Okay, the other thing we have going on is we've been talking about this U.S. dollar, and we are now, let me just catch you up to date here where we are. We're now trading above 97. As you can see, we're really close to the 98 breakout level. And if we get out of that level, folks, and it's certainly, we've come out of here really strong. We got up to 97.30 last night and this morning. So we are starting, to see this thing, break up to the outside. And we get above 98, that's going to break all of those cycles that are up there, the 618 and 786, 127, and the two 1.618 levels. So this market continues to move higher. This is meaning that the euro continues to, go down. And remember, on Friday we're going to have the Chinese renminbi is coming into the mix for the SDRs, special drawing rights. This will affect the U.S. dollar. The euro will only be 53% versus the U.S. dollar. Excuse me, the dollar index will be 53%. Will go down to 41% with the inclusion of the euro into the special drawing rights. So this will be something that will be very important, I believe. We don't know. The question is, how will this impact the dollar and stuff? We really don't know them coming in. None of my friends have ever traded the renminbi. I've been to China many times, and so I bought and sold renminbi. When I first started going there in '94, it was 12 renminbi to the dollar. And they also call it the yuan, but renminbi is the actual name of it. And now we're down to, I believe, 6.6 renminbi. It's been in half. So it cost twice as much to go there as it did, way back 20 years ago. So we'll have more information on it as it goes. And, it's going to be a great thing to be traded. It'll probably, be the number 2 currency in the world very, very quickly would be my thoughts as far as trading, because there's so many, so much business is done there, and the volume of it should be pretty good. Now, remember that the Chinese folks over there, they have commodity markets, but they don't have foreign exchange. They do have stock markets and stuff, and the buildings that they have, they pale what ours are. I mean, they're huge. The Shanghai Stock Exchange is just it blow the New York Stock Exchange away on a technical basis and size and everything else, but they don't do the volume that we do here, because they're preferring down into the future that's what's going to be gone. That's what I did for the Merck, was I went to China to talk to the students at the university level, at the graduate level, to explain to them what speculation means and what these markets were going to, when they started to open up and we would have free trade and everything, how the buying and selling would happen and how, capital moves between countries and things like that. So that's the main thing. Okay, here's someone Duffy put a really good information. The euro is 57%. The Japanese yen is 13.6. The pound 11.9. And this will change as of Friday. When we come in, they'll have some new ones coming up and we'll be able to do it. I'm not sure if all this is related to why the bonds are breaking down, but again, I'm just a technician. I'm looking at the bonds breaking down for a long time now, and they're getting worse and worse as you can see each day. The rates are going higher. I wouldn't be surprised. There's a lot of talk about the Fed being a non-political organization, but the Fed is a money-making organization, folks. That's what they do. It's a private bank for bankers, so keep that in mind. They'll do anything that they want to do, and they'll put their positions on, and they have a huge amount of capital behind them. So as Shane Smolyan has told us many times, don't fight the Fed. So we want to keep that in mind also. Fortunately, Shane has missed the brunt of the big hurricane. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're back, and we've had a request to talk about Twitter a little bit. You remember we completed some major patterns here at the $25 a share level in Twitter. That this was the ABCD on the daily. If you'll notice the huge gap that we had at the old highs around 20. Now, Twitter has come down to $20. It's trading a little bit below 20 right now into that area. So this is probably going to be some pretty good support for Twitter. The problem is that supposedly 3 of the major bidders have moved out. That was Google, Disney, and Facebook. But that was reported. But like we mentioned before, that's not always the case of what we're looking at. If we look at Twitter, on the really long-term basis, you'll notice that we made that 1.618 expansion, ABCD down at 14. Then we rallied up to 25, which is 61% retracement of the high from October of last year. And so this is some major resistance, but this will probably be bought out. But gosh, who knows whether it's going to be a big deal or not. Most of the stuff has been taken away. But we'll see. I mean, compared to what's happened in the British pound, you see that the Twitter is basically pretty much a non-event. So those are things that you want to remember because you have a whole lot of things to consider. We've had another question about the gold and silver. Folks, I can't see any reason here to recommend the long side of gold or silver at this level. The reason for it is the fact that, we've been way below the Fibonacci numbers. We're $10 below the Fibonacci number in the gold, and we're way below it in the silver. So there's no really reason to look at it. We have lower targets that are setting up. We've had a $17 rally almost perfectly in the gold, which is 1/2 of the harmonic number of 34. So that's just a normal thing that's going on. So I just don't see any reason here to be long gold and silver at this particular time. And remember, we have a really unusual lunar event coming here on the 14th, a week from today. We're going to have Syzygy, which was the moon is going to be as close to the Earth as possible, which is one of the things that Norm Winsky yesterday of Astrotrend talked about, that you do have extra earthquakes and stuff happen around that time. But it is a super full moon, basically, is what it's going to be. And we've seen these before, along with some other astro stuff that's happening at that time. So this is going to be a really key spot to look at. And if you'll also remember, we had Bill Meridian on from Cycles Research on Monday, and he really iterated the importance of this mid-October low that's going to be supposedly coming in here. So we'll watch it, very, very closely to see if this is going to be the case in here. Now we've had a little bit of a back here in the corn market. Let's just do this really quickly here because I really like corn. We were able to buy some of this and take 13 cents out of it. Let's try it again, 23 cents out of it, which was really quite nice. And now we're backing off, and we want to be looking to get back into the corn. But frankly, I'd like to get it a little bit lower. Let's just put this up here. I'd like to get the corn down about another 6 cents. That would be something that I think would be a pretty good thing to look at because it's got a very nice pattern on the long-term dailies. We've had that head and shoulders pattern that we talked about several times, but this is one that looks like it could be, very, very interesting. I'll put this corn chart up on a half hour so you can see what I'm looking at and be able to see, what we're going on at this level. So, it's really really a great thing to trade if you're going to trade anything, just by itself. Boy, corn is really a really good one to trade. It's the largest of our crops. Foreign currency to me is the best, but if that scares you a little bit, corn is really probably one of the better things to trade. It's very, very liquid, and it's very, very volatile, and it gives you really good risk reward versus the margin and things that you have to put up. So that's a good thing to keep an eye on is corn. I I don't particularly like stocks, folks, because you have these dividends, and then you have these buyouts, and all the other stuff. But the foreign exchange is the easiest to do, and then the commodities are pretty good. So we'll see if that's going to happen. I know we're everybody's concerned about what's going on with the hurricane. Of course, we've chatted with Shane a few times here the last few days. And luckily, they've gotten a lot of wind and some rain, but nothing nearly as bad as they were expecting in Miami. It was not a direct hit. And from what John Logan said, same thing was happening there in North Carolina. They were getting a lot of rain, but so far they haven't been hit too badly. That doesn't mean it can't change. Certainly, we don't want to have another Katrina or Sandy. That would be another one that would be really, really devastating. But let's hopefully pray for the folks that this is not going to let this happen. Let's get on to the stock market. Folks, we've been in a downtrend in this market for quite some time, basically sideways. It hasn't been going too much. But you'll notice here in the New York Stock Exchange Index, still heading down. We've not broken this downtrend line at all. We've just made those, 78% retracements, just like we've had in the DAX. Not much any different than that. That doesn't mean it can't change, but right now that's what's looking, from the charts. It just is not anything really happening. Whether the Fed is going to come in, do anything or not, remains to be seen. But there's probably some political things going on. But whether that's going to mean very much to the overall market or not, we're not really quite sure. We have a question about the silver. The silver market, folks, it had a chance to hold, the 1760 level. It didn't do that. It broke another 40 cents below it. We've still got lower targets in silver. I can see no reason to buy the gold or silver in here. Short term, you could probably find some nice retracements. But, for a longer term position, I certainly cannot recommend, anything like that to be in the market for any particular time. Now, the dollar yen, we've talked about this several times. We did get up to the 104 level in the dollar yen. And now we're starting to get a little bit of a pullback. But basically, the dollar yen has turned the corner here, and you want to watch for a retracement, on the downside of dollar yen. And probably being Friday, you would probably have to wait for a day or two to get a nice retracement. But you really need to watch that dollar yen, especially if it would back off, to like the 102.25 level. It would be very, very interesting, to see the thing moving, and you'll be able to watch what's going on here. So it'll be very, very important to keep an eye on that. Okay, now we're going to show a chart here from one of our good friends, Jim Bartolioni from San Diego, California now. And basically it's the long-term chart of the cash S&P from when it first started trading back on March the 4th, 1957. And we are coming in to some really key timing points with this 1, 2, 3, 4, 5 expanding top pattern.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new Market Safe Focused Commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 6 equally weighted commodities, including gold, silver, copper, nickel, soybeans, and sugar, in one powerful CD. With annual pricing caps of 50% per component, you could earn up to a 50% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The October 13th funding deadline will be here before you know it. So hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, Swim Lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, we're back, folks, and we're taking a look here at the dollar-yen on a 4-hour chart. This goes back over the last several months into the middle of June. As you can see here, we're completing this ABCD pattern. We're not there yet, but we've had a really nice move off of the Gartley pattern that we had down at the par level. It got to par 004 as the low, and now we hit a high of 104 and change. So watch this level coming back in the 102.50 level. That's going to be very interesting. The 102.75 will be a 382 retracement. That's another one that we should watch. But this has potential for some bullishness here, especially since the thrust we've had over the past few weeks here, since the middle of September. So it's got some legs to stand on. That's primarily what you're watching. Now, the most important one is the next one we're going to talk about, and this is the Treasury note market. This is the one that's telling us that it looks like rates want to go higher, not lower. If we take a look at this, you'll see here that after we hit the 382 retracement, we've been down for about 10 days. We took out the lows to September, and we're trading above that early this morning. That was after the non-farm payroll number came out. So we should be in an area for some type of a small rally here in the Treasury notes. But the overall trend of the notes certainly has a bias to the downside. You can see the butterfly pattern that was made up at the top. This is when we're hitting 177 in the bonds, and we're trading at 164 now. So we are going higher interest rates. Whether the Fed comes in and does anything or not, I'm not sure. We've not been in a situation like this before, brought on by this quantitative easing that is, everybody across the world is taking it up, looking at negative interest rates. And as Bill Meridian mentioned to us on Monday, there have been negative interest rates in the past, going back to the days of the Romans. But trading going on at that time compared to what we have right now. So I don't understand how negative interest rates work. I can't get anybody to pay me money to borrow money from them, but maybe the government's certainly a lot different than anything else. As far as the stock market with the S&P and stuff, we need the S&P to get below 2138. That's about 12 handles from where we are right now. Whether it'll do that or not, remains to be seen. Now, the next question that someone's asked is about the crude oil. Folks, we've been watching this crude oil for quite some time. The number numbers say that we should be heading, higher up into that to the $56 a barrel level. We have taken out the highs that we made back in August up at that almost 51 and change level, but the overall target in this crude oil still looks like it wants to go higher, up to around $56 a barrel. That's 10% from where we are right now. That doesn't mean we can't get some pullbacks, but I would look for any type of an ABCD structure on an hourly chart or half-hour chart to be looking to go to the long side, because we have broken out to the upside. We made the 78% retracement of the low from April, and we made the 50% retracement of the low from February, and then we came down and tested the beautiful Gartley pattern at the 61% retracement where it missed by 10 cents, and now it's still going higher. So it looks very, very interesting, from a standpoint that it does have higher price to see if this is going to work to the upside. That's what it looks like anyway. Someone's asked a question about the soybeans. I think the soybeans still look good as long as we can stay above the 940 a bushel level. I believe we're trading at 950 or something right now in the November beans. We've had some really strong support here at the 78% retracement, which was at 940. So we still have a chance on this one to the side, but right now it's just backing and filling with lower tops and going into a sideways move. Remember that if these markets make these major bottoms like this and don't come out of here really strong, you have to be skeptical. That's what happened to both gold and silver. Remember, we hit that really strong 37-day cycle, and the market took off. It rallied $50 in 2 days in gold, and about $1.50 in silver, and yet the market turned around and took out those lows, telling us that it was bearish. And again, the gold and silver still look lower to me, so we've got to stand aside and wait. I'll be doing a lot of work on this over the weekend, to see what's going on, especially with the currencies and the stock market, because all this stuff is certainly interrelated. And with the big Astro stuff coming in on the 14th of October, with the full moon, we certainly want to have our ducks in order, at least to see where we are standing with some of these other patterns that we're watching through here. But silver, silver really has a lot lower to go. The 61% retracement in silver, folks, is all the way down the 1650. That's $1 an ounce from where we are right now, so it could very easily get there. If gold can move $50 in a day and a half, silver can certainly move down, $1 an ounce. But at that point, I would have to really be interested in the long side of silver, and 1190 would be the price that I would be looking at in the gold market. If you remember, 1275 was the number we originally liked in the gold, but the fact that it went through there like it didn't exist told you that it wanted to go to lower prices, and now we're trading $10 below that level right now. So when these things don't work, you've got to stand aside, because markets are never wrong, men are often wrong. Those were the words of Roy Longstreet. So keep that in mind, and remember, it's always better to be out of a market wishing you were in than in a market wishing you were out. And that means that the market's going against you. Do you know the difference between a speculator and an investor? An investor is a speculator who didn't use a stop. Those were the words of Jesse Livermore. So remember, the stops are for protection. You have to use those, because if you don't, you're telling the market that you know more than it does, and that's not always the right thing to do. So that's pretty much what trading is all about, if you want to, put 2 dimes to a nickel. Anyway, that's what we're watching here this morning. We're going to come up to a break here, then we'll finish up with the rest of the markets. But we want to keep a very close eye on this British pound here, folks, because it's got a chance to make a major bottom in this level right here. So let's keep a really close eye on this, and we'll see how it all works out in the near future. The VIX index is still down in the same area where I think it's going to be. That's where you should have a little bit of a some money to buy a November or December call, I think would be a thing to do with about a $15 call. Or $15 VIX call, so it's not going to cost you very much. It gives you some pretty good protection. We got all the way up to 20 on the last run, so that doubled in price. So that's another one that looks really interesting from a long-term perspective of watching this. The number in the S&P, folks, for me is at 2138. 877-927-6648.
My name is Steve Rhodes, author of Mastering Probability and host of the Trader's Edge Show heard daily here at TFNN.com. On Wednesday, October 19th at 5 p.m., I'll be hosting a special one-hour event, Trading Range Boundary Lines, where I'll teach subscribers how to identify hidden support and resistance levels, the kind that you definitely need to be aware of for your trading and investing. You'll learn how to plot major horizontal support and resistance, how to identify breakouts and breakdowns, and how to project the next price move. These support and resistance levels work for stocks, ETFs, futures contracts, currencies, and these patterns work on every time frame. By signing up for Mastering Probability right now, you get the first month of my newsletter service for only $49, and that includes October 19th's Trading Range Boundary webinar. Plus, if you sign up now, I'll include access to my 3 one-hour workshops, the ultimate trading signals, the ultimate reversal signals, and the long-short line that every trader needs to know. This is an investment you won't regret. For all the details of the upcoming workshop and reserve your seat today, visit the front page of TFNN.com now.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're going to wind up the show by taking a quick look here at December corn. As you can see, we had a really nice head and shoulders pattern. We had this on the air, of course, right at the 325 level. The low was 325. It stayed there for almost 2 hours. And then, of course, the USDA report came out, and the market, exploded a little more than $1,100 to the upside. And now what we're looking for is to see if it will back off one more time to this level right around 331, which would be down about $900 from the high, about 18 cents. That would be a very, very low risk entry point. in the corn. Now, if we only come down to the 382 level, which would be around 337, and it takes several days to get there, we're trading at 342 and change right now, that would even be more bullish. So we have to follow that as we give it a little bit more time to see if the pattern will unfold. But we did make a really nice ABCD pattern off of the Gartley, which also happened to be a head and shoulders pattern. And now we're waiting to re-enter the market when we first get our next buy signal, which will probably be in a few days. So we'll just have to stand aside and wait to see what's happening. Maybe it goes up and makes new highs, then we'll miss some of it. But right now, it's best to wait to see if we're going to get one more retracement. Someone's asked a question about the cattle market. We've tried to have Rich Anderson of Anderson Capital Management on, but he is just swamped with all the things that are going on in foreign exchange markets and also the metals markets, because he has a lot of folks that trade a lot of gold and silver, and so he gets very, very busy and can't be on the show. But we'll have him on just as soon as he's available. We're also going to have Shane Smolian on as soon as they get this storm out of the way in Miami Beach. We'll have him back on the air also to give us some pretty good ideas. So the main thing to remember here is we won't get a breakout in the S&P unless we get above the 2184 level, and below 2135 is a break to the downside. 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.